Concerns over inflation and interest rates due to the Iran war saw S-REITs take a hit in March. Share prices have since bounced back. But are dividend yields attractive at current levels? And should you be buying S-REITs now?
So one of the key valuation tools that we look at would be the dividend yield that is offered by the Singapore REIT. However, it is important to understand that it does not mean that a higher yield definitely translates to it being a better REIT. That may be because of the fact that the dividends being paid out by the REIT may not be sustainable.
It does not mean that it's an automatic buy for dividend investors, and the reason why is because at 6% dividend yield, we still have to look at the fundamentals of the REITs.
In some cases, higher yields reflect higher risk, not better value.
There are weaker REITs where they might be yielding at least 6% or higher, but that is also because the market already expects that the dividend might get cut going down the road.
Compared to safer assets like government bonds, S-REITs still offer a yield premium.
Right now, the Singapore 10-year bond yield is roughly at about 2%. Singapore REITs in general are paying about 5.9% dividend yield. So if you look based on that comparison, it does look attractive. At the end of the day, we still have to look at the risk to reward ratio of this Singapore REIT. So even though Singapore REITs might be trading higher than our Singapore government bond yields, we still have to figure out what are the fundamental risk and the quality of these assets.
But that extra return comes with risks. S-REITs are highly sensitive to interest rates. That drove the sector's decline in recent years. In 2025, easing rates helped S-REITs recover.
Investors have effectively erased away any expectation of further rate cuts this year. So what investors are looking at now is an environment where interest rates may stay higher.
And that uncertainty continues to cap upside. While yields may look attractive on the surface, not all REITs are created equal. Some are seen as safer local assets. Others are more exposed to global risk.
Singapore REITs are split into a dichotomy of two different buckets. So on one hand, we have Singapore REITs which own physical assets based in Singapore, and these assets tend to be highly priced by investors who tend to see these assets as a flight to safety qualities. Now, on the other hand, there are also Singapore REITs which do own high quality assets, but they could be widely exposed to the global environment. For example, these assets could be situated overseas or have tenants which are subjected to global impact. For instance, some of these companies might face disruption by AI, and they might be tenants of some of these industrial assets. We also might see sectors like the hospitality assets or the hospitality sector, where they might have exposure across the world in developing and developed markets, where they own hotels and service residences. They might be exposed to global economic headwinds.
Beyond interest rates, investors are also watching three key risks: growth, costs, and currency exposure. To drive growth, many REITs are turning to acquisitions.
With the fall in interest rates over the past 12 months, we have seen increasing appetite by the Singapore REITs once again to be able to make use of acquisitions to be able to grow their distribution per unit, because that would be one of the ways that the REIT would be able to unlock value for unit holders.
What I'll pay attention to is after the acquisition, whether the REIT's overall DPU would increase or decrease. You could see whether the DPU would have been accretive, meaning that there will be a positive increase in the distribution per unit, or there will be a negative adjustment. That means that the distribution per unit will be revised downwards. Singapore REITs have to be very careful with what they purchase, because the cost of capital, whether if they are raising money from the stock market or if they are raising money from banks and loans or investors, they have to be very careful not to borrow more than what they can reasonably collect from the yield from these properties.
Rising energy costs could also weigh on payouts.
So using, say, an office building as an example, that may be something that the landlord might have to bear if that is not something that is embedded within the contract with the tenant. And if energy costs were to become elevated, that may then eventually impact the distributable income of the REIT. And I think if I were to look at the data center segment, that is definitely one of the segments that is very exposed towards electricity costs.
For REITs expanding overseas, currency is another factor. A stronger Singapore dollar can reduce returns.
The natural required rate of return from overseas assets have to be higher because of the currency headwinds or the currency risk faced by these REITs. For example, if you look at REITs investing in Japan or in the emerging markets in Southeast Asia, where the emerging market currencies could weaken against the Singapore dollar, any repatriation of rental income from the overseas market could result in a reduced income because of foreign currency exchange.
Put it all together, and the picture is mixed. Yields are holding up, but so are the risks. If you're unsure where to start, here's a simple checklist.
Look at the fundamentals of the REIT, whether it has a strong occupancy rate, whether it's able to enjoy a good rental income growth. Next, we look at the balance sheet of the REIT in terms of whether it has a very high gearing level, whether it has a lot of debt, because that will allow us to understand whether the REIT will be able to withstand a higher interest rate environment. Last but not least, we want to look at the valuation of the REIT. We look at what is the dividend yield that it offers. We want to look at what is the price to book valuation of the REIT, because by understanding that, we can see whether the REIT is attractively valued and whether that meets our income criteria for us to invest in the REIT.
And in today's market, investors may also want to look beyond REITs and diversify across other income assets. Because it's no longer just about chasing yield, but understanding what you're getting in return.